Hello and welcome to today's webinar on home purchase, picking your lender and down payment assistance program. I am Jessica Leal and I am the Small Business and Housing Program Coordinator at San Pablo Economic Development Corporation. At San Pablo EDC, basically San Pablo EDC is an economic development hub in the region, and we offer workshops and trainings for businesses, workforce, and future homeowners. We deliver a wealth of programs through collaboration with other partners and innovative in-house programs. Before we get started, here are a few housekeeping items. The webinar is being recorded. In a webinar, you can also find all the webinar recordings on our website at sanpabloedc.org. Any resources mentioned during the presentation will also be available on our website. All participants are muted, and we welcome questions. So please use the Q&A box, which is located at the bottom of your screen, to submit your questions, and we'll get to them at the end of the presentation. Again, San Pablo Economic Development Corporation is a full-service organization for economic growth in Contra Costa County. We offer technical assistance for businesses, membership and sponsorship benefits, access to capital, home ownership, job development and career counseling, degrees and certified training, and employment support and services. So please visit our website or get more information. Today we have our special guest, Emma Biggie, who is the Vice President of Community Lending and Diverse Markets from Banco the West by BMO. Emma will be going over home mortgage lending process and how to prepare you for your purchase. After Emma's presentation, we will have my colleague, Suhey Mojica, the Business and Housing Manager, providing you information on down payment assistance programs such as WISH and our SPLASH program from San Pablo, the San Pablo Loan Assistance for Sustainable Housing. And now let me turn it over to Emma for her presentation.
Good evening, everybody. Thanks, Jessica, for the introduction, and thanks San Pablo EDC invite me as a partner to participate the community outreach, the home ownership, financial literacy, and the small business all around to support the community. Tonight, we have the home ownership, especially talking about the lender's perspective, and also down payment DPA program in the neighborhood and what about it. So let's dive in. Jessica, I need to share my screen, right? Yes.
Yes.
Okay. So tell me. Yeah. So tonight, our topic is your or our path to homeownership. This journey is a little bit long for some people, and also maybe a bumpy road. We're going to encounter a lot of ups and downs. So definitely we're here to support, and we're going to hold hands together and really travel together to achieve the home ownership. Before I really dive into the real content, I want to have some disclaimer here. Basically tonight, what we talked about are more of the general information. It's not related to specific file decision or case files. So if you're have some questions about certain scenario or situation, we would like to take offline to discuss, especially involve some personal information. Definitely, this is all loans are subject to credit approval by the lender, by any lender, not just the Bank of the West, BMO, by any lender. So I will be the representative for the lender side to talking about some of the key aspects the lender is looking at it, how to qualify people for a loan, and how lenders see the business of lending money out. Benefit of homeownership. Everybody see the benefit of the home ownership in a different way, but we summarize everything. Most important is going to be listed right here. First is proud of our personal achievement is, and also have owning a piece of a real estate, and build up the family wealth for the future. We consider as a family legacy. That's a starting point. Also, the sense of a community. Sense of a community is very important because we know home ownership more get us tied to a community. We live there, we're breathing and eating and raise a family, everything and anything in that community. So we care about the community, not just a location we stay in specific spot. We actually involved almost economic every aspect of life. So that's why it's very important. So this is the benefit of home ownership. But home ownership also bring in a lot of responsibilities, a lot of other things. Some people considering their whole own home style, home arrangement, or home strategy, life strategy, they may not consider homeownership is the right way to go. That will be a lot of other aspect we also want to point it out for the people to be realized. Owning home is not just a very small undertaking. Sometimes need a lot of responsibility, planning, and also discipline. Steps to home ownership, there are certain procedures got to follow through to reach the home ownership, because it is a purchase, it is a transaction we're talking about in the industry, but also this purchase and transaction is almost the biggest one in the household for a regular people. So it is going to take some preparation, take some mind setting piece to really conclude it to the transaction. First and foremost, before we reach the homeownership, the title, we got to understand a couple of things. Number one, understand our credit, understand what we're going through, the product, the services, who are the parties involved in this processing. And also, most important thing, we need to know our price tag. We need to know our wish list, what we are willing to compromise achieve in this transaction. And then get into the weeds, we need to go through details. What is the qualification? What type of things we're really talking about through the lenders, through different parties, what we're facing. And then we're going to find a home. This is the other part, we talk about preparation, we talk about the money piece, but we still need to find the final alternative goal is to find a home to do the transaction. So those type of things are one step of each other to moving forward. So that's something is we definitely need to going through. Now, quickly going through this, we're going to touch upon some key point from a lender perspective, what we're looking for, and what the homeowner or potential homeowner, home buyers wants to know. The key piece is to achieve this transaction, to become a homeowner. First and foremost, like the previous slide said, we need to understand credit. Why credit is important? Because a credit is basically is the portfolio for us, and profile for us as a consumer to showcase how are we doing in the finance piece, the finance in overall, not just one piece is purchase the house. We're also looking at how are we going to treat money in the household? How do we value the money in the household and the management? So talking about a credit, there's two concepts that we need to talk about. We need to talk about credit as money itself. That's what we said, credit. The other piece is talking about a behavior. How are we doing with our money handling capabilities and actions. So those are behavior. Behavior is more like a yardstick to measure how good or how bad or where we stand in our overall profile. So everybody heard about credit score. Everybody know the credit report, more or less. Technically, before you talk to lender, I highly recommend everybody go to annualcredit.com, annualcreditreport.com to pull your own credit report and to see what you have in that report. Because that report is pretty much our profile or whole map picture. What do we do with our finances since the day one? We establish certain credit with the lenders, with the banking, with other institutions, because the credit report is not just recording the financial transaction. They have other things on the report, some legal issues, some debating, questionable accounts, and all those may not be just the banking, maybe other parties. So that's something is we need to pay attention to and to see what's on that report. And after that report, we need to know where we are at our credit rating. Credit rating reflected in the 3 digits credit score. Normally the score limited from 300 to 850. That's the modern score system gave it to us. Each individual person has our own score mark. Well, if I see our host, Sohee or Jessica here, 3 of us, we all have a certain scorecard. If I see Emma's scorecard is 650, how do we get that 350? Who tell us we have the 350? What the calculation, what come to the 350? So those are the questions we want to know. It's not, we want to know the answer of that. So by looking at that, I presented this pie chart for everybody to looking at it. This pie chart is a very famous industry credit score pie chart, is telling us whatever report we have, based upon the report actions and the behavior, that we got a score, our scorecard, which is our credit rating. Where the rating coming from? How are we being rated by somebody else? So this is the content about the rating. When we're looking at the chart on the left side, the 2 ratings was the highest percentage mark. This is basically the whole pie chart is 100 points. It's our rating, 100 points. We're in the school, right? So 100 points. On the left side, there's 2 items give us the most points. What are they? Why they gave us the most points? By looking at the name, is actually telling us what is important in our credit behavior. Number 1, payment history. What is a payment history? History is telling what's happened in the past. And in the past is recorded something to tell the current and the future, who we are, what we are, how we behave. So payment history translated into the simple action on the credit report is whether we pay the bills on time. Simply put, whether we pay the bills on time. If we open the history from the history book, the starting point, we open that, and every month, year in, year out, we behave consistently and persistently, guess what? Our score is going to reward us. If we want to get a good score, we want that payment history is being spotless. There's no derogatory, there's no late, there's no diminished spot there. Has to be clean. So that's why payment history gave us the most. Then the next category gave us the higher point is amount owned. This amount owned, 30 points, actually has a double meaning. That's a tip for everybody to walk away. First, 30% of our behavior related to amount owned basically is our debt. How much money we owe somebody, how much we're in debt with somebody. So of course, if we owe more, this score point is going to be affected. Why? Because it's a risk. If we owe somebody more, that means we got to repay them back. Because we paid this debt back, that's all going to affect our purchasing power or our money power in the household. So that's why amount owned carry the second most important score for us. The other piece of, I said this is the tip, because this 30% point actually is indicate what's the ideal household debt percentage. Normally around 30% of versus the income in the household. That means the household debt level is quite ideal, is pleasant. In other words, is we have a plenty money value to cover that debt. Thinking about this way, if we make $100 as income, doesn't matter is pre-tax and after tax, we're just using the money value itself to tell the story. We have $100 in our pocket, $30 we need to pay somebody else on monthly payment, in and out. So we have 100. If we pay somebody else is $30, that's out already. We have $70 to spend. So that's pretty good. Why? Because that's have enough reserve to cover if we want to spending more. That's why this 30% is about. So that's why I said it is a tip for everybody to take home and to think about it is if you are calculating your current household income and liability, you can use this as a benchmark. Remember, this is a benchmark. Is not a judgment is good or bad. It's just say is benchmark for ideal, because of the ideal talking about we have more resources to fall back on. It's not to say, oh, it's totally bad, because some certain people, even they make a lot of the money, they still can run this amount owned as high, because that's the management skill plays in, that's a plan plays in. So that's why it's not a judgment. It's just the way look at it, how we can balancing the debt and the income, the money value. Now, the other three items on the chart is much easier to understand and also carry small points. That means is some certain behavior, it does carry significance, but is not too large. We need to pay attention to regulate our certain behavior, but overall won't take a two chunk of our money to really, a two chunk of our credit rating for this behavior. One is new credit, and the other one is credit mix. These two almost side by side. New credit basically is telling the creditor, telling other people how we behave if we see some opportunities to open a new debt. In other words, is spending. So if we have a disciplined mind, we can control some spending. This 10% is going to be well managed. The other one is credit mix. That's going to telling us if how mature we handle the different type of liability. Credit mix can be long-time debt, short-time debt. What we say is a rolling debt, which is a ongoing, or installment or one-time deal. So those are different type of a mix, different type of a liability we handle in the household will give us a lot of saying about ourselves, how mature, how skillful we handle those debt. And then the other piece is 15% credit rating goes to length of credit history. Credit history and payment history are two different things. Payment history is talked about specifically a behavior. Credit history is our long and short financial story. How long we get into know this system, credit his system, how well we understand using money. So those are kind of give everybody else idea how well we are doing with our finances. Now, we talk about the credit, quite some in depth about the reading piece. But before that, I mentioned everybody should get a credit report. Before we know the credit rating, we need to know what drives the credit rating, which is this free consumer credit report website, annualcreditreport.com. This is the platform being sponsored by the 3 credit bureau. It's basically is the 3 bureaus set up this platform for consumer to access their report. Many years ago, the 3 bureaus have their own website. You go to their own website to get the report. Nowadays, you only need to go to one website to get a 3 all report together. It's still a separate report. It's just from one platform. You can get access to all 3 together. So that's convenience. And also because this platform being sponsored or supported by the 3 bureaus, so the accuracy of the report are noted. In other words, this is not just an individual consumer report, any of other financial institution using or put it out there. This is a official site for the consumer to compare notes. So pretty much is the data in this website is equivalent from the data the 3 bureaus collected. That's pretty much matching with each other. Of course, there are some miss and hit, but not too far apart. There are some differences between the consumer report and financial institution report. We, as a lender, if we are qualified people for the loans, we pull the credit report. Those report also from the 3 bureaus, but those report has a little bit more content because that report is served for the financial institution to looking at it to make the decision. So that's be more a little bit richer, but overall the framework won't be too far apart. And also we provided the consumer report request services contact information, the mailing and calling, just in case any of us need the report, find the report and find something is not correct on the report. We need to do some updates. This information is very handy because this type of report correction actually take time. So all the bureaus would like to see the written request the traditional way. It's not just an online format. You fill it in and submit it and quick and easy. This is not a quick and easy because there are some investigation and research done. So they do want to consumer handle this situation seriously. Now, we mentioned a couple of things regarding to the credit and credit report. For getting the improving or understanding our credit and credit reading, what are the tips or suggestions or recommendations we put on the table? Normally, there are few spaces definitely has a room for any consumer wants to improve the credit rating, want to understanding the credit portfolio or profile. So first is build the credit file. Build a credit file means is we've been consciously planning to say, I want a credit. If I want my credit financial reputation looks good, I do need to have a plan. This plan is not just to say, hey, I'm going out to open 5, 10 of credit card. No, it's not about that. It's about, let's sit down and look at it. For building the credit, normally short-term credit line or credit can build quickly because we're going to see monthly income, monthly payment, monthly running the credit line, and in and out all the time, money play out in and out all the time, can really show my character, how well I manage money. So that's one way. The other way is looking at the pie chart, we know different type of credit, different type of a liability we are going to take on. So for example, if I do have kids in the school or consider to send the kids to the school, I would consider to borrow money for student loan to help the kids to go to school and also build the credit. Car loan, that's another one. If I'm running the business, I would like to do some equipment. I would rather to borrow the money to buy the equipment and build the credit. Why? Because borrow money, that's save, the purpose is to spend all the own savings. The other thing is build a credit and have a lot of a saying on my ability to manage money. Saving is a good thing, but really the key point, the most important thing is not about a saving, is about a saving and a spending and manage money. Manage money, we can constantly saving, constantly spending, constantly enjoy the life. That's the key point. Don't miss the payment. That's another major point. When we talk about the credit reading, the most points we got is payment history. We talked about that. It cannot emphasize more on that piece because payment history does telling people how disciplined we are. Basically tell the characteristic about the person. If we handle money, we know we need to pay the bills. Regardless, the bills is $1 or $100, $1 million. If we handle that well, we're going to show on the report, a show on our reputation. So that's simple, just like that. And then pay down the liability, pay down the debts. Well, that's also another high points on the credit rating piece is if we control the debt within the ideal level is 30%, we're being in the good shape. In other words, we have a tons of resources to fall back on instead of we are stretching too thin and to spend it too much. The other thing is discipline. Do not open too much new accounts or borrow too much, because that is a life trap because we all like good things. We all like to enjoy things. That's our human nature. We want to enjoy this moment. But for a financial wealth building, a lot of time we need to control the temporarily, the current desire and go further for the future. Now, the other thing is go back to the mortgage, go back to the homeownership is a lot of people really concerned about down payment. What is the down payment? Down payment is the home buyer come in with their own investment upfront to purchase the house. Down payment is nowadays is actually considered is a key piece to own the house. Why? Because that's also the lender to say homeowner be serious about owning the property. Down payment is the skin of the game, is equally play the part with the lender, because that's when we are in the home ownership, especially started the lending processing, the lender and the homeowners is getting into the business relationship. We're doing business together. So you want the lender comes in to support, and the lender wants to see the homeowner comes in to back it up the homeowner's action for the long run. So the down payment is very, very important. For a larger down payment, will give a little bit more comfort for the lender to consider lending money out. Why? Because of risk. If I only lend 50% of the loan of $1 million versus I need to lend it the whole million out, 100% of $1 million loan, that's make a big difference for the lender to qualify the buyer. So that's the whole down payment concept behind the story behind it. What type of sources of down payment? Of course, because the down payment coming from the buyer side, buyer can bring in the money from savings, from checkings, from the resources on their own. But also nowadays, there are so many channels, so many resources the buyer can seek outside the buyer's own home to find the support. This is talking about the government, local government support, local nonprofit support, and even the bank itself support. For example, currently, the Bank of the West, the BMO, we have our down payment grant, lender grant. So basically is if the lender qualified per the program requirement, the lender can walk out $10,500. You purchase any houses in the Bay Area, including Central Valley, and a lot of certain areas the lender defined. So those type of programs definitely is good resources for the home buyer to check it out. Also, San Pablo EDC is a WISH program, local WISH program, which is a famous down payment system program administrator. So if you work with San Pablo EDC here, you actually can see whether you can get almost 30,000 free money from the San Francisco Federal Home Loan Program, which is called WISH. So those type of a program is out there for consumer to pick and choose, and also to compare. There's a couple of things I want to put on the table for the consumer to understand. Down payment system program, if it's not a grant, the program is just like the mortgage, is you borrow the money. So got to be very careful if you have this money for free or you have this money as borrowed money. If a borrowed money, the money carry the similar weight like you borrow the mortgages from the lender. The money is going to be recorded on the house. If the money is default, guess what? The house is going to jeopardize the house ownership for the future. So that's something for a homeowner definitely need to, when you looking at options for down payment system program, you do need to looking at that. And also down payment system program has a very independent, unique way to be qualified. So they are different loan program than the mortgage. If you want to adapt the down payment system using the down payment system program to help to purchase the house, you are going to go through the two qualification program. You are going to qualify for the down payment. You'll also qualify for the mortgage. They are equal position, and you got to go through the both system at the same time. So for that reason, consumer do need to give yourself a time and also be prepared for the qualification, because the down payment system program also require a tons of documentation to showcase the capability of the home buyer. So that's something for home buyer to really understand. And also they have their unique criteria to be qualified. You feel no surprise, the lender of the down payment system program can say no to the consumer, because those program is not designed for everybody and anybody. They are picking the people are qualified for the program, and qualify the program designed to serve the population. So there's a different way to looking at it. For that, you definitely need to, as a consumer, need to be very careful. Also, down payment system program can be accepted as a gift from the family members. That's something you also need to consider, because nowadays, a lot of times, the family can pool money together to purchase the house. So that can be a one solution for the down payments there. Talking about mortgage programs and product, I would consider at this moment is hard to define anything substantially outstanding here, because there are so many and so much programs out there. Every lender has a whole arena of the program pool there for consumer to choose. So there are not much really we can talk individual. It's just too much to talk about. And so what we are going to talk about, a couple of things, is you need to pay attention to some certain terminology being used in the conversation with the lender. One is ratio, debt to income ratio. The ratio is going to define how much you can qualify. That's the pure yardstick for the lender to take it, is a ratio. They calculate the ratio in a different way, and different ways to measure the household responsibility. The ratio only calculate the house expenses. The ratio to calculate all the household expenses together. And also the ratio, after the ratio, they also talking about residual income percentage. Those type of ratios are just here ratio, lender is talking about qualification. Sometimes your loan officer come out to say, hey, Sohee, your ratio is a little bit high. Can we do something about this ratio? You got to understand that that's the language they're talking about. Either we're going to raise the income or we lower the debt, one way or the other, because the ratio are involved, those two things. If they're talking about that, we need to work with the lender to really see, can we pay off some debt? Can we get more money to contribute to income? Are there any income resources we didn't recognize in this qualification piece? Also, there are something is in the future, are there potential income is going to play in the returning money for the lender? So those are the conversation piece you are going to, as a consumer, is going to hear. Down payment, we talk about it. The other piece, we'll talk about a cost. Cost of doing the homeownership is kind of substantial. The cost is just not a dollar, not some petty cash. They can talking about a large sum of money. I just gave you a roughly idea. If you purchase $500,000 a house, the average closing cost for that transaction is 3%. So 3% of $500,000 How much is that? You can calculate. For that amount of money, that's quite a large sum for a simple transaction. Well, it's necessary. Why? Because all the parties involved in the transaction needs to be paid. And also, all the parties involved got a service got to be paid. And also there's a prepaid services happen in the transaction is be part of transaction. For example, the taxes and the insurance and the prepaid interest, all those can be part of the cost calculation there. So for that, you do need to be prepared for spend that much money. But good news is, no matter what, the transaction cost is there. Who paying that cost can be negotiable because there are so many parties involved the transaction. You can negotiate the price with the lender, with the seller, with the agents, with the service providers. So there's a money saving opportunities there. As a consumer, the only piece we need to keep in mind and be aware, the opportunity is there. We need to negotiate. We need to have that in the conversation. There's a question I'm thinking is, mortgage payment, this is the principal, interest, tax, and the insurance. Those are basically is a major mortgage payment we talked about when the lender talking to calculate your house payment. So it's very easy to understand. The only thing need to point it out is taxes is a property tax. It's not a sales tax. It's ongoing. So and the insurance is also ongoing because you purchase the house. You need to pay that property tax. You need to pay that insurance to put a protection for that house. If you don't own that house, those expenses is not there. So does the loan. So that's why this PITI, principal, interest, tax, and the insurance is very important for you for the consumer to understand because this is related to the house. Pre-qualification and pre-approval, those are the two items you talk to the lender. They are going to verify and evaluate your situation. Pre-qualification basically just as simple as an estimate. Pre-approval is different. Pre-approval is going to be fully underwritten file and guaranteed evidence to show you are having this much money being agreed by the lender to lend it to you. If other conditions, the verified conditions have not changed in the future. So that's something for you to understand. Sample of a mortgage product and programs, as I said, there's too many and too much. You literally need to understand some basics is conventional loan, which is the Fannie Mae and Fannie Mac conforming, and also government loan, which is a USDA loans, FHA loans, VA loans, and then the portfolio loan, which is a lender's own program. We call it is either is a jumbo loan, is portfolio loan, or non-sellable, which is the loan is not selling to Fannie Mae and Fannie Mac, can be portfolio loans as lender. For those type of information, we talk less. The reason for that is either they are in the mainstream, you handle that all the time. For the consumer, we don't really have much choices because we got to see what we qualified for. So if we qualified for is only our situation allow us to pick one program, it's only one program to qualify us. As us, there's no choices. So that's the program, we go with it. So that's why I said it's really, once we pick up that or we're being picked for that, qualified for that, the lender is going to explain very detailed what's this program about. So that's something is not what we say and make decision. The only decision we make is we're not going to take the loan. Other than that, there's no other way out there. Mortgage product is home ready product. This is one of the product is talking about the first time home buyers. Basically is you have, that's one of the question asked is, what's the minimum? Are there any limit for the down payment? Here we go. This is the live example is certain product require certain down payment. So currently in the market, the minimum down payment, if they require the down payment, the minimum payment is 3% for the conforming or conventional. Well, there are some programs that they said, well, we don't need any down payment, but 100% financing. That's only one loan. That's the VA loan. Well, this VA loan is not for everybody. It is only for service people. So that gave you some idea. What I said is there's too many and too much. So it's really coming in to say, hey, if I'm ready, I did my homework for working with the lender. First of all, you need to work with a lender. You need to pick up somebody specifically getting into the conversation and hear the overview, what I can have. And then we go to the details for the features and next about the specific program. Finding home is much easier nowadays. Is literally, you will see the agents everywhere. Is pretty much finding things at your fingertip. We go online searching, we pretty much done everything there. So it's not hard to find the information, but it's hard to sorting and filter the information. That's why this education become handy. Why? Because we educate ourselves first. So our education, the knowledge will help us to sorting the information because we are living in the information galaxy here. So it's not the information we're lacking, it's the right information we can use. Something for that, we need to make sure we got the right resources and right knowledge and to understanding the right situation. Owning home is definitely possible. We have so many support here. You have me as a lender. You have Jessica and Sung-hee from our agency from the nonprofit to helping us to sort it out. So our help is out there. The only thing is we need to reach out to say, hey, I want to do this. Let's start a conversation. With that said, I want to give back the stage. That's pretty much my piece of the home ownership and the down payment, everything. Any questions you can put in the Q&A. So I gave the stage back to Sung-hee. Thank you.
All righty, thank you, Emma. Can everyone see the screen and can hear me fine? If you can just give me okay, perfect. Well, thank you, Jessica, for the introductions, and thank you, Emma, for such great information as always. Good evening, my name is Suhei Mojica, and I am the Small Business and Housing Program Manager at San Pablo Economic Development Corporation. So far you've heard from Bank of the West in regards to mortgage lending and how to prepare and what kind of information it's important to know. What I'm going to present to you now is additional resources that are available for low to moderate income home buyers. And one of the programs that I will be discussing today is the first-time home buyer down payment assistance workforce initiative subsidy for home ownership, also known as WISH. As you can see on this slide, WISH provides up to $29,000 in down payment and closing cost assistance. In order for to have they do a 4-to-1 match, and in order to have those funds awarded, the home buyer must contribute $7,250 of their own money. And there are other ways, as Emma mentioned, based on the guidelines of this program, They don't necessarily have to be monies that are saved from the buyer. They can also be considered a gift from a family member, but there are more specific guidelines, and I'm only going to focus on the basics. A lot of this information will be available on our website if you prefer to learn more. There's also no payments due. This is a 20% is forgiven for every year you reside in the property. After 5 years, 100% of this grant is forgiven. Funds are available on a first served basis with a fully executed purchase contract. And what does the fully executed purchase contract mean? It means that you must have made an offer in a property, and that offer was accepted by the seller. Therefore, you are already in contract in order to become the home buyer or the homeowner of that particular property. And again, the funds are subject to availability. This program, the first round of funding, or actually the funding will be open beginning April 1st. Wish funds may only be used toward down payment or reasonable and customary closing costs in association with the purchase of a housing unit to be used as the primary residence of the home buyer. Therefore, it cannot be a rental property. It does have to be the primary property of the home buyer. The qualifying criteria for Wish are: the family income must not exceed 80% of the HUD income limits for Oakland or Fremont. In this case, we're using that particular area. But Wish is actually can be used anywhere in California. The borrower must be a first-time home buyer. Borrower must occupy the property as a primary residence. The borrower must complete an 8-hour of HUD-approved first-time home buyer education. And the debt-to-income housing expense ratio must not exceed 35% of the gross household income. There are ways now that the Federal Home Loan Bank may consider anything above the 35%, but it's on a case by case. And that is where we at San Pablo EDC can help the home buyer look into if there's a specific situation that needs to be reviewed. The property has to be a single family detached home, a condominium, or a townhome. Those are the only eligible type of properties that are available for this type of funding. We have another program that we administer here at San Pablo EDC, and this is a little bit different. Wish, as I mentioned earlier, it is a forgiven grant that 20% is forgiven every year up to 5 years. The second down payment assistance program that I'll be talking to you about, or I would like to introduce you to, is it's SPLASH. So what is SPLASH? SPLASH stands for the San Pablo Loan Assistance for Sustainable Housing. It is utilizing the San Pablo Housing Successor Agency funding. So this funding comes specifically from the city of San Pablo. The mission of this program is to help low-income individuals and families become first-time home buyers in the city of San Pablo. We know that higher home ownership is directly correlated to a more engaged community. And so note that the funding, again, comes from the San Pablo Successor Agency. So this assistance applies to houses with the incorporated San Pablo city boundaries only. Lastly, the city of San Pablo invests a great deal in helping its residents accessing living wage careers. Therefore, the goal of this program is to retain those individuals in San Pablo. The loans, again, are made through, this is considered a deferred payment program. So it's also known as the silent second. As you recall, Emma mentioned something about down payment assistance programs vary in determining how the assistance is made possible to home buyers. So in this case, this is something that needs to be repaid, but no payments are required until the end of the term unless the property is sold or otherwise transferred, including a refinance. The loan amounts are up to 20% of the purchase price of the home, not to exceed $100,000. So you're able to receive up to $100,000 in down payment assistance. There is the loan interest on this is the greater of shared appreciation or 3% per annum simple interest. And that is something that if you need a better understanding, we do have the guidelines on our website, and you're more than welcome to, go in there and read more as to what that means. The length of the loan is up to 30 years, unless, again, the home is sold or refinance. This program was designed to allow borrowers to establish a term that works for them without a penalty or early payoff. So you can definitely pay it off early if that is something that the buyer wants to do. The program allows the borrower to have a debt to service coverage ratio of 40%, or based on what the mortgage lender says it's acceptable. So they are willing to look at a higher debt to income ratio. That is to say that their mortgage payment can constitute up to 40% of the household gross loan income. And basically, if the Splash program were to charge an interest instead of relying on appreciation, the market were to suffer a sharp decline, the borrowers would be on the hook for the principal and significant accumulated interest. So by using the shared appreciation approach, it provides some mitigated risk for borrowers. This down payment assistance program may be used in combination with other programs, such as the WISH program that I mentioned earlier, and other listed on this slide. I do recommend that you, whoever that's on this webinar today, that you speak to your first mortgage lender to explore the opportunities that are available to your specific situation and needs. And then we also, recommend to work with the lender of your choosing to get pre-qualified to purchase a home that meets the income, the housing price, and the debt to income ratio requirements detailed in the Splash program guidelines. So for the application process, as you can see, whether it's for Splash or WISH, we prepare and submit a complete application to the program administrator. All of that material is available on our website, or you can reach out to us after this webinar and we'll be more than happy to provide you with that information. Once you submit the eligibility process that we would need to know, we would need supporting documentation for income and asset verification of all household members. For Splash specifically, there is a 100 non-refundable application fee, but normally we do a pre-eligibility before you even have to submit this payment. And lastly, you definitely need to attend a HUD certified first-time home buyer program, which usually lasts about 8 hours. You receive a certificate, and that certificate is good for 1 year. So in the process that you're working with your lender and you're working with a realtor to find a property, you can definitely do this certification, and you have a whole year to use it. And then here's a roadmap that we have created here at San Pablo EDC that explains the home buying process. If you would like a copy, you could definitely reach out to us, or again, visit our website. This is all available there. It does give you a detailed roadmap as to what you can expect in order to become, a home buyer. And sometimes, as Emma mentioned, the best recommendation that we would provide is that you start working with the lender of your choosing. Talk to them about your specific situation, because there may be a time where we've had some borrowers or some home buyers that have to work out either credit situations or other different things that you may be required to work on before you can even start looking for homes. So again, I hope that has been helpful. At this point, just to be respectful of everyone's time, it's almost 6 o'clock. If anyone has any questions, we will be more than happy, Emma and myself, to answer any questions that you may have. Do we have any, Jessica, do we have any questions?
At the moment, we don't. The questions that we did have been answered.
Okay, great. I'm not sure if one of the questions that was asked was, Emma, you mentioned the annual credit report and how individuals can go in there to look at their credit score and to see what they have in their report. When they take out this credit report, does that affect their score, or is it seen as an inquiry, or no?
No, annual credit report, they don't give any score. This just giving out the credit report information. So there's no credit rating involved and also no checking involved. It's just the consumer personally put the data. So there's no credit inquiry. And also on the same note about credit inquiry, not all the inquiries is going to affect the score. Basically, the inquiries may generate the more debt, potential debt in the future that can consider an inquiry. But if some people checking the credit for information purpose, that won't hit for the credit rating. For example, employee potentially want to check the employee wants to check the potential employee's credit report. That won't hit as an inquiry. That's just the information sharing.
Okay, great. Thank you. I just wanted to make sure, since that's available as a free resource out there, that individuals can definitely take advantage of looking. And it's always good, even after you become a home buyer, to always monitor your credit for any discrepancies. So I guess it's 6:02, and I want to thank everyone that was in this webinar today. And as you can see in our screen, you can definitely visit our website for you know, any questions, or to look at more detail in regards to our programs that we administer. And if you would like to get in touch with either Emma or myself, you know, we have shared that information with you. So with no further ado, I guess we can, yeah, we can say thank you to everyone and good evening.
Thanks, everyone. Take care.